Hey, I'm Drew Nichols here at LTC Tree, and I'm with my cousin slash business partner, Derek Wilkins. Hey, Derek, how's it going?
Hey, good, Drew. Hey, guys. Thanks for watching our video. Today, we're going to talk about what, Drew?
All right, today we're going to talk about a topic that recently came up with one of my clients, a client in Georgia who was basically she was on the fence. She had the cash to do a single premium payment for her hybrid long-term care policy,
Okay.
and she was deciding, should I do that or should I spread my payments out over 10 years? So I know we both have lots of thoughts on this, Derek. Let's roll.
Okay. Got it. Yeah. What did she end up doing?
Well, the thought process is we're still working through some scenarios, but here at LTC Tree, we really like to put our client forward first. So what we did was we looked at a couple scenarios with an income annuity and some other options that I'd like to talk to you about today.
Yeah. So, hybrid long-term care insurance, that's a product where you're paying your long-term care insurance off upfront. You can either do a single premium and it's paid off, paid over 5 or 10 years, but whatever payment method you choose, it's paid off. Now, the question is, what's better? Should you give the insurance company all the money up front, or should you pay it over 5 or 10 years? Because obviously, if you give the money, say it's 100,000, if you give them 100K up front, you're not earning interest on that for the next 10 years. So, what are your thoughts?
Yeah, and this equation is going to change over time. So we're recording this video as of the summer of 2024 and currently in a relative to the past higher interest rate environment. And so that changes the calculus a little bit for our clients. So let me give you some real numbers. For her, and again, these numbers vary a little bit based on age and things. For my client, it was going to be $100,000 single premium for her long-term care policy for her hybrid plan. Or if she spread it out over 10 years, it was going to be $130,000 paid over 10 years. So 13,000 little slices every year for 10 years. So again, kind of going through this hypothetical math, we looked at taking an income annuity and just taking the 100,000 instead of giving it to the hybrid plan, putting it in this annuity. And this is a concept you and I have both worked with a lot. So maybe you can explain that.
Yeah. So what these are called income equity index annuities, which the bottom line is whatever money you put in, it's guaranteed to never lose principal. And because the Fed funds rate has moved up so much the past 28 months, it's gone from pretty much 1% to 5.5%. It's made these annuities much, much richer than they were just a couple years ago. So it depends on your age, but whatever money you move over, there's products out there that will give you an immediate income based on your current age at the time and your life expectancy, guaranteed for the rest of your life, or you have the actual growth of whatever the funds grow your account to. And there's a lot of name brand funds that you can put the money in. So you almost have I think right now the best one is out there is an 8% guaranteed compound return for the first 10 years guaranteed. So that's your safety net. And then you're indexed to these brand name funds like Fidelity, Barclays, Morgan Stanley, Goldman Sachs. And if those obviously outperform the 8%, then all's good. But if it doesn't, you have to fall back on the 8%. That's not a bad safety net to fall back on.
Yeah, so I like these products because you do have that safety net with the opportunity to take a shot for growth. Now, let's go back and review her numbers again, and I'll put some charts and things on the screen. She her premium was going to be about $13,000 a year for her policy if she spread it over 10 years. Her life expectancy is about 25 years based on her age and her family history for longevity. What we could do is instead of putting that 100,000 single premium in, we could buy her $7,550 a year in income for her entire life. So if she lives out her normal life expectancy, this pays 70% of her premium for the first 10 years and then continues for the rest of her life.
Yeah, now this also comes with some tax deductibility for her too. How does that play into it?
Yeah, this played in for her in particular because she's a small business owner. So she's able to deduct, and this is again based on your age, and I'll put a link in the show notes to this chart we've got. But based on your age, you can deduct a certain percentage of a lot of these hybrid plans. Anytime we talk taxes, I always say this is what our clients have done, but ask your CPA about your specific situation. In her situation, she's able to deduct $5,880 of that premium off of her taxes, which, in real dollars in her pocket probably saves her about 2 grand. So we're getting closer and closer to being able to pay that long-term care premium and then have lifetime income.
So let me make sure I get this straight. So as opposed to giving the 100K to the hybrid long-term care insurance company, she gives it to the annuity company, generates a lifetime income, has the opportunity to grow in the market, and that pays what, 70% after you factor in that tax deduction of her long-term care premiums.
Yeah, it's
So at
actually
the
more than
end,
70. So
yeah,
just the annuity lifetime payment is 70%. Then we get another 2 grand, which is about another 15%. So we've got 85%, 85% of her premium covered, and then lifetime income plus growth. So it kind of comes into no-brainer territory if you have just a little inkling of financial discipline.
yeah, that's a great idea. Well, I'm sure she's very pleased that you showed her that idea. And we're LTC Tree. We work with all the companies. We help our clients shop, and we've been doing this for a quarter century. I know we look young, but I started doing this right out of college, and we've seen all sorts of scenarios. So if you ever want to get shop the market of all the long-term care insurance companies, any of the annuity, equity index annuity companies, fill in the form below. We'll put a link in the show notes and reach out or call us anytime.
Yeah, yeah, and this is a new concept for us. It's something we've just been doing the last couple of years because the market has come to us and things are so much better. Great chatting with you about this concept, Derek. So, anybody out there watching, subscribe to our channel because we're going to be doing a few more specific scenarios you might like to kind of unpack with us. We're LTC Tree, and thanks for watching.
See you guys. Thanks. Hey, I'm Derek Wilkins. Today we're going to talk about how to use tax deferred retirement accounts to pay for long-term care insurance. We're LTC Tree. Today I'm here with my cousin Drew Nichols and business partner out in California. Drew, how's it going today?
Hey, Derek, it's going well. Yep, I'm Drew here at LTC Tree. We're cousins, we're business partners. We like to talk on YouTube about specific cases we run into every day. We work with literally thousands of people to do their long-term care and sort of, legacy planning. And you were telling me about one of your clients, you were telling me a story, and I said, let's make a video about how your client was going to use some qualified funds to help pay for their long-term care.
Yeah. So, what is a qualified fund? For those who don't know, a qualified fund is it's an IRA, retirement account, 401k, 403b, an account that's been growing tax deferred. Now, once you retire, those accounts usually move with you. And, when you take it out, you got to pay taxes on the gains. But a lot of people, they don't need the income right now, so they don't want to pay taxes. So they look for places to park this money. Now, a big problem and kind of a core of all financial planning is how to pay for long-term care if you need it. Now, what long-term care is, it's needing help with eating, bathing, dressing, toileting, get home, and a nursing home and a facility. That can be expensive. It can be up to $100,000 a year. If you spend 5, 6 years there, you can blow through all your retirement. So the question we get a lot is, hey, Derek, can I use retirement accounts to pay for long-term care insurance? So what's the answer to that, Drew?
The short answer is not directly, but indirectly. And that's
Yep.
what we'll unpack that concept here in the next couple of minutes. What you really want to do is use a combination of a couple of products. So there are some companies out there. I won't mention the name, but a lot of people know. There's one company that sort of packages this all together. Where they will let you do an exchange, a 1035 exchange into the annuity, because annuities are allowed to take qualified funds if they're also qualified annuities. And this particular company, they will sell you an annuity and a life insurance package together. But we don't think that's the best option in most cases.
Yeah, I agree. I know the company you're talking about. You end up getting a watered down annuity or investment and then watered down long-term care insurance. So the best way to do it if you want to use those retirement funds is to do a 1035 exchange or rollover from one tax deferred account into another. Now you can't roll that over into a tax deferred account into life insurance because if the IRS allowed that, life insurance is paid tax free. They never get their money when you passed away. But you can roll it over into what is called an annuity, a fixed annuity or equity index annuity. So what our clients do is if they do have a long-term care planning need, they'll roll their IRA, for example, over into the index annuity, tax free. And then there's various annuities out there. There's probably 50 of them that we can work with. All are going to give you indexes to grow your money, whether it's Fidelity, Barclays, Morgan Stanley, Goldman Sachs. There's just a variety of them. There's even an AI index. Which company had the AI? I think you're talking about the AI index.
Yeah, Athene has a couple AI powered indexes. But Derek, let me stop you right there. I thought annuity was
Yeah.
a bad word.
Yeah. Well, you're right, and that it earned that name for good reason up until the past couple years, because the annuity market, it really thrives on that Fed funds rate. And if you think back the past almost 20 years since the financial crisis, the fixed rate market has been very low. And so a fixed annuity, the insurance company has to guarantee that whatever money you give them, you can't lose a dime in it. So since they have to offer that protection, there was just not a lot of interest rate, room to go around.
Yeah,
So,
they didn't have a
if
lot
they
to
took
work
your,
with, basically.
yeah, exactly. If you give the insurance company 100K, they can't just go put it in the stock market. They have to go buy a treasury or something. And up until the past 2 years, they were getting like 2% on it. Now that Fed funds rate has risen up to 5.5, they're getting 5.5%. So right now, this is the best the annuity market has been in 25 years. So which just gives so many more opportunities for our clients.
Yeah, and right now, just for context, because these YouTube videos are evergreen, summer of 2024, in the past, we would have never made this video, but today we can confidently say, if you plan right and you take a portion of your IRA, by the way, we're not ever advocating anyone take all or even the majority of their
No.
401k or IRA, take a portion of that, transfer it into a specific type of product. That product is going to allow you to, without any penalties, withdraw every year enough to cover your entire premium on that long-term care plan. And that also provides you some additional potential tax deductibility on the long-term care plan versus just paying it all up front in one lump sum. So it's if you've got a little bit of extra cash, it's a really smart way to do this.
Yeah, and it also gives you an opportunity to participate in the stock market without the downside risk. I mean, we've just kind of been looking at some of the illustrations from these various companies, and depending on which mix of funds you end up using, they've averaged anywhere from 7% per year for the past 10 years, all the way up to 15% per year if you wanted to be into more like a NASDAQ type index. So conversely, if the market goes the other way, these indexes have a floor of 0% return per year in negative markets. So that's the safety net. In negative markets, you don't lose principal. Every year you get a gain. That's those gains and principal are locked in. So that's the new floor.
Yeah, and full disclosure, some of them do have some fees. So a savvy consumer and a savvy agent will help you see those fees. Look out for those. We try to guide people towards a good balance of returns and fees. But I just think this is a great way if you've got that money sitting in a qualified account, whether it's an IRA, 401k, and that money is sitting there with a relatively low return, maybe in bond funds, CDs, something like that. You can move that entire lump sum into this product and then slowly but surely trickle out and slowly but surely pay the taxes on those gains to pay that long-term care plan. Kind of kill two birds with one stone kind of thing.
Exactly. Well, that's what we wanted to talk to today about, guys. Thank you for watching the video. We're LTC Tree. We work with every long-term care insurance company, every index annuity company out there. So if you ever want to get quotes, fill in the link below. Call us. We're here Monday through Friday.
Yep. And thanks for watching. Bye-bye.